Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we're lucky enough to be joined by Chris Verrone. Chris is a partner at the firm and head of their technical and macro research effort. Chris, how are you doing this morning?
I'm doing great, Ross. Always great to be back. Thank you.
Thrilled to chat with you today. Really fortuitous. We are chatting 1 year from the S&P 500 low made last October. I think an unexpected rally, but also not one without its warts and idiosyncrasies. So I was wondering if I could just turn the floor over to you
Yeah.
and talk through some of your big takeaways a year off that low we made last year.
Yeah, it's hard to believe. It was exactly a year ago. I remember it distinctly. I was in Milan, Italy at a client meeting. And I remember we had a very hot CPI number that morning, and the market traded very sharply lower. And then by the end of the day, I think S&P had reversed some 200 basis points higher. And it was the first message that, hey, when markets start to act better on bad news, you have to pay attention. And clearly over the last year, S&P up roughly, call it 20%, NASDAQ up closer to 35. Certainly been a good move at the index level. What I'm troubled by, or what I find curious, is under the surface, it has been a very different picture. I mean, here we are a year off the low, and you still only have about 40% of US stocks above the 200-day moving average. That's remarkably light for the first year of a new bull market. The first year of a new bull, Ross, as you know, tends to be the broadest, the rising tide. It's the most fun. Everyone makes money. This has been different. And I think we're asking ourselves the question, why has this first year off the low not resembled what we're used to seeing historically, that rising tide? And I think the two other interesting data points, as you mentioned, 1 year off the low, S&P is up 20 and change. Small caps are only up about 4 or 5%. So the Russell 2000 only up very, very modestly off last year's low. Again, very, very unusual. Typically, small caps are your leadership coming off a market bottom. It would be more normal historically if, frankly, if small caps were up 100% here, not up 5. So that's another kind of very unusual feature of the last year. And then I'll give you one more, is first time in 100 years. We went back and looked at every market bottom the last 100 years. First time ever, banks are down. So the bank index is down about 20% from this time last year. Now, certainly there's been an event there with the regional banks earlier this year, but again, it's unusual. So we kind of step back and we ask the question, okay, index is up 20, NASDAQ's up 35, banks are down, small caps have done nothing, and only about 40% of issues have really participated in this. Why? My sense is, or my guess is, that the market is still unconvinced we've had a complete economic cycle or a complete business cycle. And I wonder if that's going to be a more important story as we look ahead to 2024. But great question to start. I think this first year off the low stuff has just looked so unusual to what we're used to.
Yeah, I think you're right. Really reflective of a unique economic backdrop, some points of strength, some areas of obvious weakness, but all set against a rising rate environment. And, I think it's really interesting. We've had obviously turmoil and human tragedy in the Middle East that has given a bit of reprieve on rates. But I remember something you wrote in the aftermath of Russia's invasion of Ukraine, which is that the broader economic trend tends to kind of remain or stay sticky amid these geopolitical events. Higher rates and higher oil have been the move of the last few months. How do you assess those two things, those two big, economic and market headwinds, amidst this kind of challenged backdrop here?
Well, I think you're right. First of all, absolutely horrific and tragic events in the Middle East. But when we look at the impact of geopolitical events on markets, we kind of have a saying that surprises in this business tend to break in the direction of the trend. And we've been in this, Dan Clifton and Jason Trenner have talked about this very multipolar geopolitical world. And when I kind of think about what that means for equities or for rates or for oil, I would really continue to respect the trend here. I recognize over the last 72 hours or so, bond yields have come off the boil, right? They've come in from, let's call it 480 back to about 455 or 460. But just don't forget how dominant this trend in rates has been. And also, don't forget just the very simple observation that historically, it's called last 75 years, 10-year yields have traded about 200 basis points above what headline CPI is. So we got headline CPI this morning. Let's say you're even really, really optimistic about where inflation may go over the next year. Let's say you're in the 2 or 2.5 camp. I think that's too optimistic, but let's say I'm wrong and that's right. Put 200 basis points on top of that. That's roughly where historically 10-year yield should be, 4, 4.5, maybe 5. So I think we settle somewhere in this neighborhood. I know there's a lot of people out there trying to call a top in yields. I just think that's dangerous when the trend has been so prolific for so long.
Yeah, obviously a multi-year bear market in bonds, reflective of that big move in rates. And I'm sure a lot of people have called the top across that time. So, Chris, let's end there. I think that's a really, really useful summary of where we are today. Really great insights. And I just want to thank you so much for the time.
My pleasure. Great to be here. Talk to you soon, Russ.